With Colorado Front Range Properties, and today's presentation is all about home sales taxation and the healthcare reform. I'd really call it about debunking the myths here, because really we're going to try to set the record straight about what this 3.8% tax is all about. Much of the material today is presented to you through the National Association of Realtors, and it's designed to go ahead and let you know what's really going on and how this 3.8% tax is really being calculated. So let's talk about what you're going to learn in today's presentation. One, is there really a real estate sales tax or a transfer tax associated with this new bill? And then why is this called a Medicare tax? And then what will high-income tax filers be subject to? Will they have lost any mortgage interest deduction or not? And who is a high-income tax filer? And then tell us, most importantly here, how the 3.8% tax is actually calculated. And of course, last but not least at all, is what happened to the $250,000, $500,000 exemption that we also enjoy? And does this new tax pertain to primary residences and or investment properties? Let's take a closer look now. First of all, is there a real estate sales tax or transfer tax associated with this new health care bill? Absolutely not. It is not a real estate sales tax. We really want you to understand that it's not a real estate sales tax. This has really been a myth, and we are here to go ahead and set that record straight today. And particularly in view of the fact that we have an election year here coming on, and it's 2012, and this tax does take effect in January of 2013, there's been a lot of scare tactics, you might say, that have been associated with this 3.8% tax. So we're going to set that all straight here. So why is this new tax called the Medicare tax? Well, as we all know, Medicare and Social Security, to which of course Medicare is a part of Social Security, is a bit on shaky financial ground these days. And this new tax here is designed to go ahead and shore up the Medicare Trust Fund. So the monies that are generated from the earned and unearned income will go into this particular Medicare Trust Fund to shore up that account there. And they're doing this because, of course, we have more and more baby boomers that are going to be utilizing Medicare as years to come, plus to protect the benefit of generations yet to come. So will high-income tax filers lose any portion of the mortgage interest deduction that they so enjoy today? Since, of course, this appears to be targeted to that audience there. The answer to that is no. The mortgage interest deduction will not be changed for anybody at all. There is absolutely no cap that was imposed upon any itemized deductions at all. So they will be able to still continue to take the mortgage interest deduction. We want you to clearly understand that. Now, who will be subject to the new taxes imposed by healthcare legislation here? The new 3.8% sales tax will apply to the unearned income of high-income taxpayers. And another 0.9% tax will apply to the earned income of many of these same individuals. Both levies, of course, are referred to as the Medicare tax. So who are these high-income taxpayers? Well, that deserves some definition. The tax filing status for single will be subject to the unearned income taxes if they have an adjusted gross income of more than $200,000. So that's the adjusted gross income for single individual taxpayers if they have more than $200,000. If you're a married couple filing a joint return with a new adjusted gross income of more than $250,000, you will be subject to that 3.8% tax. Now, if you happen to be a married couple filing separately, then of course the return is subject to a $125,000 threshold for the adjusted gross income. I know these numbers can be confusing, particularly when you couple it with the primary residential exclusion. So let's take a closer look at how some of these numbers play out. First, let's talk about how that 3.8% Medicare tax is actually calculated. That tax is assessed only when the adjusted gross income, as we said before, is more than $200,000 for a single individual or $250,000 for a married couple. The adjusted gross income also includes the net, that's an important word here, the net income from interest, dividends, rents, capital gains, as well as any other kind of compensation that might be reported on the 1040 form IRS tax return. The tax is not imposed on the total adjusted gross income, nor is it imposed solely on the investment income. So rather, of course, you know, the IRS has got a formula. So they're going to use the formula to go ahead and calculate out what that 3.8% tax should be. So the taxpayer is going to determine the lesser of the net investment income or the excess of the adjusted gross income over the $200,000 or $250,000 adjusted gross income threshold. So thus, if the net investment income is the smaller amount, that's where the 3.8% tax will apply to the net investment income amount. If the excess over the threshold is the smaller amount, then the 3.8% tax would apply only to that excess amount. So let's take a look at an example here. For a single individual taxpayer, let's just say that their adjusted gross income is $275,000. Now that means that the excess over that $200,000 limit is $75,000. So for hypothetical reasons, so let's say they had some investment income and that yielded $60,000. So the 3.8% tax will apply to the smaller amount, and in this illustration it applies to the $60,000. Now let's look at another example with that same single individual taxpayer. Let's say that again that their adjusted gross income is $275,000. Again, their excess over the limit is $75,000, but their net investment income yielded $90,000. So again, that 3.8% tax will apply to the smaller amount, but in this case, $75,000. So now let's go back and talk just a moment here about what happened to the $250,000 and $500,000 primary residence exclusion. Where did it go? And it went nowhere. It's still there. So any gain from the sale of a principal residence that is less than $250,000 for the individual or $500,000 on a joint return for married couples will continue to be excluded from the income tax. And by the way, this is a tax credit, you might say, that you are able to take advantage of once every 2 years. Now, the new 3.8% tax will not apply to this excluded amount of the gain. So, does the tax apply to primary residences and investment properties? So the answer to that is simply yes and maybe. Yes to primary residences and maybe to investment properties. So how does that 3.8% tax apply to any part of the gain on the sale of a primary residence? This is the hot button. This is the hot issue everybody's getting up in a storm about. The new Medicare tax would apply only to any gain that is realized that is more than $250,000 or $500,000 respectively, you know, if you're an individual or if you're a married couple, existing on the primary home exclusion, known as that taxable gain. And again, only if the seller has an adjusted gross income over the $200,000 limit if they're single or $250,000 limit if they're filing as a married couple. Those thresholds stay intact. So let's take a look at a couple examples to illustrate this point. If you're a married couple, and let's say you sold your primary residence and your taxable gain, say, might have been $30,000. So the adjustable gross income, including that taxable gain, was $180,000. So the 3.8% tax would not apply because the adjustable gross income was less than the $250,000 allotted for that married couple. If, on the other hand, we have another married couple and their taxable gain is $30,000, but their adjusted gross income was $290,000, then that 3.8% tax would apply because the adjusted gross income is more than $250,000. So again, it's going to be the $30,000 taxable gain that would be subject to the 3.8% tax there. Note that what we're not doing here is we're not taxing them, not kind of double dipping, if you will, on the difference between their adjusted gross income and the maximum amount allotted. So they only get charged the 3.8% on the smaller amount, in this case the $30,000. So I know that this is a complicated topic at times there, and if you'd like to know more about the home sales taxation issue, you want some clarification on that. Number one, speak with your CPA or your accountant. You want to know your numbers. And two, if you're thinking about buying or selling property at all, speak with a realtor. Consider converting a personal residence into an income property, and consider also doing a 1031 tax deferred exchange. I'm Cheryl Garlock, and you can reach me at 719-321-7600 or drop me an email to Cheryl@coloradospringsbesthomes.com.